Hey guys, it's Sean Zinn, the Connection Machine, aka the Insurance Doctor. I have a special treat for you today. We're going to do a webinar with some high-powered individuals. We have a CPA, we have a realtor, and we have a mortgage originator, and myself in the insurance world. And we have Alexander making his first appearance on our lives. I want to make sure, before we even get into it, guys, I want to make sure that you all make sure you subscribe. Make sure you subscribe. I'm going to bring on my first guest. We have Chris Whalen. What's going on, Chris?
Hey, good afternoon, everybody. I'm ready to present today. Got a lot of good information.
Next up, we have brenda.izzo. What's going on, Brenda?
Doing. Hi, Sean and Alexander.
And we have Kristin.Hess. What's up?
Hey, how's it going?
How's everyone doing today?
Good. So we might hear babies and dogs barking. So we're having a good time.
Hey, we're being real. This is not. We're not
This is
blowing
real
smoke.
I'm coming live from my princess room where I do all my work.
Keeps you on your toes.
With her big dogs, you have your new little baby. Chris, I know you're always babysitting too with your grandbaby. So
yes,
it's fun to watch all that.
No, I'm glad we're all able to get together. And what is our title? Debunking those tax and home buying myths that are out there. And before we even get into it, let's go a little intro. Like tell our audience who you are and what you do, and we'll go a little round robin. I think on my screen I have Chris, then we'll do Brenda, and then Kristin.
Thanks, Sean. I'm Chris Whalen, CPA. I have a full-service CPA firm right here in Monmouth County in Red Bank, servicing the whole country. We specialize heavily in everything real estate, brokers, agents, commercial properties, do a lot of investability analysis for people, and just tax analysis related to their business and any investment properties. But we're a full-service firm, so we do everything that you would imagine a CPA firm would do.
Excellent. I appreciate you being here. And Brenda.
Hi, Sean. Hi, everyone. I'm a realtor with Coldwell Banker. I do commercial and residential, and everything from building projects to just rentals to sales in the Northern Jersey area. I switched into real estate after 30 years on Wall Street, so I'm very happy with the change.
Thank you very much for being here. And Kristin.
Yeah, hi there, everybody. Kristin.Hess, Homebridge Financial. I actually have been a loan originator for going on 29 years in every capacity, from owning a mortgage brokerage to now I'm an independent agent for Homebridge. And I have been running into, the reason why we came up with this whole thing is I've been running into clients that are so, they don't get the gist of how beautiful home ownership is. And I just wanted to get the experts on here and have like a little talk show set up so that we can kind of debunk these myths that are out there. Because me saying something about a tax related thing, even though I'm what's called a certified mortgage advisor, a CMA, I'm not a CPA. So I figured that's why we needed a good CPA in here to kind of be the voice of that. I think it just gives more weight to everything coming from factual instead of like fake news, things you hear on the internet. This is everything we're going to talk about is based off of true facts, government credentials, like everything that we have is something that's recorded somewhere in history. It's not us just using our mind saying, oh, well, we think, or we heard, or this is all factual. So hopefully that'll clear the air.
No, I appreciate you wanting to do this because I'm all about value. And for those that are tuning in, I'm in the insurance industry. I'm an insurance agent with Maello and Manzi. We have a variety of companies that we could write your homeowner and flood insurance through. And we're all about getting the best coverage for a fair premium, not cheap. A lot of people say cheap, and that's a bad issue you're going to have. You're going to have cheap insurance and pay a lot of money down the road because of things that are happening. So I want to make sure that everyone understands you got to have people in the corner. And these are people that you should have: a CPA, a realtor, mortgage professional, and an insurance agent that is on your side. So let's go. I know we have some notes as far as how the process would go. And I think Kristin was talking about having a $400,000 mortgage payment.
Yeah. I'm going to see if I can share this screen with you that I made just a little bit of a chart.
And for those that are out there, we're live on YouTube. I'm actually moving it over to Facebook as well. It's going to be all over the
You
place
see my
when we're
little
done.
slideshow here?
We are live. Yep.
You see the slideshow?
Oh, there it is. I have
Okay.
them.
So
Here we go.
basically, what I did was I took a $400,000 mortgage at 7.5. I know that rate's a little high, but I just wanted to kind of give you an idea. I've had people tell me, well, you can't write off anymore. They've changed the rules. So I want to kind of have Chris touch base on that, because a mortgage payment is based off of certain things. It's got principal, interest, taxes, insurance, mortgage insurance in it. So the interest portion of a payment of $2,500 on a $400,000, 7.5% interest rate. So the first year, $30,000 goes towards interest and up to $10,000 property taxes. So you're at $40,000 for the first year. And correct me if I'm wrong, the standard deduction for a married couple is $27,700. Is that right?
Well, for 20, it's going up over 27,000 now for the new year.
Okay. So maybe you could just touch base a little bit on that to explain how, yes, you can write off these deductions.
Right. So everyone sort of lumps everything together when it comes to what are the limitations, right, on certain deductions related to home ownership. And the mortgage interest is unlimited. So mortgage interest and even HELOC interest that related to home acquisition or improvements is also fully deductible. So the only area where we have some issue is total taxes on the itemized deduction schedule, and I'll go over that in my little piece. But the benefit of being able to itemize, even if you have a limitation on the real estate tax or other taxes, that other things we can take charity deductions then. We can take medical deductions then. So itemizing, even with a limitation on some taxes, it opens us up to taking some other things that can still save tax. It makes it worth it. So I've had, like, for example, if I could just go on about the tax deduction limitation. When this happened in 2018, everyone was upset. But what Trump had done and made other changes to the law that made the pain of that less or even a positive. So I've had people that have lost 20,000 of tax deduction that are still better off because of other changes like the alternative minimum tax. So remember, if you look at that deduction limitation in a vacuum, yes, is it limiting our deduction from what it used to be? But that's only one part of the greater tax changes that make itemizing even better and home ownership even more attractive.
Exactly. So that debunks that myth that you can't write off anything anymore if you buy a home on taxes and insurance. So, I mean, interest. And also, that takes me to the next thing, too. People don't realize that they can write off the points on their loans also to get a certain rate, to buy down their rate on there. I think it's considered prepaid interest, and that's why it's able to be deducted. So maybe you can go a little bit about how they can write off their interest that they have to buy their points to get a better rate.
Well, isn't it the case now too, Kristin, that points are absolutely essential in any mortgages these days?
So
I mean, a lot of people say I don't want to pay any points, but it seems like today everybody has to pay at least something.
yeah, so basically the feds already know that the rates are going to come down next year. So the banks are saying, okay, it takes almost 2 years to break even on the interest payments to pay a loan. So like let's just give an example. If you did a loan for $100,000, they have to sell that to a servicing company. That servicing company pays a premium for that. So they might sell it for $106,000. Now, if you refinance in a couple months, they just lost their premium money that they paid to buy that loan. So they're anticipating that the rates are going to go down. So they're adding their interest on their payments on right now as in points, so that they know that they're going to make their money. They're not going to lose money, because it costs money to buy the loan from us, the lender. So that's exactly why there's points all the time now. So if you can write those off,
Right, can I make a comment about points?
Yeah.
Right. So remember, everybody, that if I'm paying points, that means I'm paying less interest over time, right? That's the whole idea. Kristin said it perfectly. So people say, well, should I pay points or should I not? The idea is that the longer you're going to keep this loan and keep the home, you're going to eventually be making money, right? I pay $2,000 in points but I'm reducing my payment by $100 a month, right? So after 20 months, I'm making money. And plus, I've gotten to deduct those points. So 2,000 of points that are deductible might only cost me $1,750 in actual net tax dollars. So if you plan to stay in your house for any decent amount of time, paying points is a really great idea. It makes you a financial benefit over the course of years.
Perfect. Yeah. So definitely we're writing off our mortgage interest, we're writing off points, we're writing off property taxes. So we're winning already in home ownership.
And one
With
more thing,
renting.
on a closing disclosure, new homeowners, they're buying remember, on the closing disclosure, formerly called the HUD-1, it's the reconciliation of buyer, seller in the transaction. There are items on that closing disclosure that are deductible that people miss. Quite often, there's a full quarter of real estate taxes taken in escrow, but they're not shown on a 1098.
Exactly.
So make sure that you have your accountant. Every time a client of mine buys a property or sells, they let me see that ahead of time so I can analyze it and pick apart everything for deductibility.
I love it. Perfect. All right. So now let's talk about the myth of a pending crash. I think I'm going to give that over to Brenda real fast to talk about what are the statistics about.
I don't know if you have the chart up, but you can see, I mean, there's a couple of, see if there's a couple of charts there. Because, honestly, again, you don't need the news. You can just look at the history. You can look at the actual history of, okay.
You see it now?
Yep.
Yes.
Okay.
All right. This is just a chart on mortgage rates. When I started on Wall Street, mortgage rates were very high, double digits. It was quite frightening.
Right up here.
Yeah, there they were. The stock market was not good. And I started at the exchange, so it was really a couple of scary years. But in any case, they're rising up now. Of course, everybody knows the Fed, increased rates 0.75 of a point yesterday. While we're not thrilled with this, it's not yet cataclysmic. There are other reasons that the market probably won't crash. I don't think it will. First of all, and mostly it's low inventory. I think people notice, buyers certainly notice that, there's just not a lot out there. There just isn't a lot out there. And the reasons are sellers are afraid. They are used to getting, they're used to having bidding wars. They're used to seeing people lined up for open houses. That does not happen now. However, prices are still firm. And prices probably will drop anywhere from 2 to 5%. But again, from where they went up to in the last couple of years, people should not be crying. The biggest problem is for a seller is where if you don't have a place to go, then you're really in the same shape. But other than that, that's part of the reason. The new home building is, we have 2 projects that are new home and they're half built. They can't get the building material prices are very high. There's a tremendous labor shortage. So new houses are not being built. So there's another part of the inventory that's fallen apart, Another reason there probably won't be a crash, which I really do not expect, is mortgages they're much more conservative these days. It's not like, you just had a pulse and you got a mortgage. It's not like that now. But you still could obviously get a mortgage, if you're remotely, viable. So it's not like you can't get one. It's just a little bit different now. So there's not so much crazy stuff out there. And for foreclosures, there's another slide up there somewhere that talks about how much equity the American public actually has. There are, I don't know where the other slide is, Kristin. It's the next one. Or some of the ones are. Where are we? We're not there.
Hold on.
Okay. Move it. Okay. Oh, the one before. Okay. This pretty much says it all. Only about 214,800 homeowners are actually facing possible foreclosure in the second quarter of this year, 0.4%. That is virtually nothing. Really, absolutely nothing. Of those facing foreclosure, 195,000, over 195,000, or 91% had at least some equity built up in their home. So they have at least some cushion if, God forbid, they have to sell. Also, U.S. households, the same quarter, second quarter, own 41 trillion in owner-occupied real estate. Of this, there is only 12 trillion in debt, which means there's 29 trillion in equity. That is the lowest ratio since 1983. And the average homeowner in the United States has 320,000 of inflation-adjusted equity. So it's very unlikely that we're going to go into the same crazy foreclosure cycle that we went through in 2008. It's not quite the same anymore. It's not quite the same. So, I mean, do I think home prices are going to zoom? No, obviously not. But I do not think they're going to crash. They'll come down somewhat. But let's face it, they were up 30% in the last couple of years. There's always a give and take.
Okay.
So,
can I make a comment?
Sure.
So doing a lot of the real estate work, and remember that the coronavirus great migration is still continuing. So the great Monmouth, Ocean County still are gems in New Jersey for everyone coming north and south and east and west to us. So I don't anticipate that stopping. Why is that? So, all right. So let's say we don't have the influx of interest we had a year and a half, 2 years ago, but now a lot of people do not have to commute, right? They don't have to, they're going to be online working. So it makes these areas even more popular because people now don't have to live in West New York or Weehawken, so this increase in value is going to be semi-permanent, I believe. I don't see a 20% reduction of any Monmouth, Ocean County home value at all. So just seeing from my clients, I talk to a lot of business clients that are moving their businesses down here. So I think we have another couple of years where we definitely are going to have really consistent pricing. So again, to go to the point here, I don't see any major crash coming at all, as if we're going to go back to pre-2020 levels or anything like that.
Yeah, and that was all because of 125% value you're cashing out on. I mean, it was crazy back then. They were giving people loans that showed no income at all, that didn't really qualify. They were giving them just some crazy loans, negative amortization loans, where every month you picked a payment. Yeah, I'd like to pay less than interest only. Like, where do they think that money's coming from? The equity in the house. So it's just a different world with that. But moving on to the stock market being a safer bet than real estate. What do you think on that, Chris? Where did that myth come from that we need to debunk?
Well, of course, the myth comes from brokerages like Fidelity and Goldman who don't make any money on real estate.
Right.
So they've demonized it for 100 years. And even real estate agents, I do a lot of presenting to them. I ask, who here has all of the homes that are on the MLS that are listed, that you've listed, ready to be sold to investors? Like, no. Not one hand goes up. So I have a couple of slides on that. You want me to bring them up?
Sure.
All right. Great.
Definitely.
By the way, I think I mean real estate is just a completely different type of investment. I mean, it's an investment you can actually live in.
Exactly.
I mean, it's a different world really than the stock market, which I was in for 30 years at Bear Stearns. So yeah.
Sean, is that up on the screen?
Yep, we're all good to go. Investment A and B.
I just want everyone to take a breath, have an objective moment, and we're going to talk about an investment A and an investment B. We don't know what they are, but we're going to go over the attributes of them. And then at the end of this little presentation of the slide, you all are going to decide what's better for you and your family's future. So investment A has very volatile and stable values. Investment B does not. Let's look at investment A. The valuations are not based in reality, but in investment B, the valuations are based in reality in a real market. Investment A, I can't hold or touch it, but investment B, I can. Investment A, there's many things out of your control to impact value. Investment B, we have a lot of things in your control to impact value. Investment A, wide swings of gain or loss and small swings of gain or loss for investment B. This is very important. Investment A, I cannot insure against any losses, where investment B, I can. Very significant difference. And investment A, there is no scientific way to estimate future value or cash flows. Investment B, future values and cash flows can be accurately predicted. So everyone now, all the listeners here, just take a little breath and say, I personally would love investment B. In every category, it's better. Okay.
I want B.
Yes.
I'm all for B.
Right. So see here, it's really the stock market and the investment property. So this is a slide almost everybody asked me to send to them. So this is a really good thing for realtors to have at their desk. And so, and all the realtors should be pushing investment property. So people out there, I don't want you to get out of the stock market totally, but if all your money is wrapped up into stocks and bonds, that's really a universe that really can't hedge against itself. So you need to diversify. So the market's down. Everyone, listen, how has the market been doing, everybody? How's everyone's ulcers doing with the market differences, right? So what you want to have is diversity, and having diversity, the best way is to get out of the market with part of your money. Real estate is one of the safest investments you can have. It beats the stock market in almost every area, as you could see from my little presentation. Once people see that, they say, "Oh, they thought the opposite." They
Right.
would think, but it's completely false because it's all propaganda, it's all fake news for the past 100 years.
Listen,
I
I
only
Bitcoin
invest in
thing.
real
I just
estate.
said I gotta buy Bitcoin. I read out, got Bitcoin. Bitcoin is, I got nothing now. But it's okay. I'm not gonna touch it. It's one of those things that you just set it and forget it. And if something happens, great. If nothing, well, lesson learned. But your home, you're not gonna set it and forget it. That home is gonna be an asset forever for you. And then the Sean will take care of it if something happens to your asset, so that it will be compensated, that you won't be at a loss.
Chris brought up something huge right there for all the agents watching. If you want that little slideshow, drop a comment with your email, and we'll get that slideshow to you. But if you're an agent today, people are scrambling for deals. Investors are the key, and people will say, "Oh, you're giving some keys out there today," because not everybody's going to take action and implement what we're talking about. But if you go after the investors, they don't care about interest rates. They're short-term minded. They're going to give you opportunities. They might have 2, 3, maybe 4 deals a month, not a year. And that just opens up your commission checks you're going to be getting because you have great relationships. I have a friend of mine I just saw on Facebook. He had 2 years ago, had 3 rental properties. And in 2 years, 10X'd it, has 30 rental properties right now. That's huge. If he has one agent, which I'm sure he doesn't have just one agent, he probably has a couple of them, because they're not basically building a relationship with him. That's where, if you're building relationships,
I try to tell everyone, when you buy this house, this is more than just today. You're going to be able to build equity. You can take out equity from this to buy something else that creates more equity that you can collect income from every month. It can trickle as far as your imagination can take you, So
we have properties up in Sussex County that are near the ski slopes and whatnot. And the prices for the condominiums and the condo hotel units are not that high, and the returns are pretty great. And that's what a lot of people are doing. They're buying them and they're just renting them out because rents are very high. Rents are very competitive, even in Sussex County, because there's no apartment buildings. There's no rentals.
And you can get financing on them, right, Brenda?
You can financing on the condominiums. It's tougher to get them on the condo hotel units like the Appalachian. But you can still get financing. Some people will do the financing, but the key is their cash flow is phenomenal.
Yeah.
I mean, it's you don't care if the price of the place goes up and down. You're getting wonderful cash flow. Rents are very tight. They're very high.
Let's move on to 1031 exchanges.
Hey, Alex.
Tell us more about that, Chris.
Okay, sure. Let me share my screen again, if that's okay. It's one of my favorite things, being the geek that I am.
No, what? Screens or 1031s. I love 1031s.
When people need to know things about this, you're the source to go to. Anything related to taxes and 1031 exchanges are a wonderful thing. So I'm glad you're going to be able to discuss this with us.
Now, everyone sort of gets confused sometimes with 1031s, but this is the most important thing. If you don't need the proceeds from the sale of an investment property, consider a 1031. Because remember, at the closing, if you take any money at the closing of the sale of your old property, it's taxed. There's no chance to defer the gain. So this is important. If you don't need the proceeds, you do not take money at the closing. That money is left with an exchange agent, usually an attorney, that will eventually bring that to the closing on a new property. So it's number one. Don't call me 3 days after you close, say, I just took $1 million in from my investment property sale, I need to reinvest it. That's too late. So always call me well before any closing. But this is the key point. If you don't need the proceeds, then we can do this. If you need the proceeds, I can't. That's the simple initial question. And then we can move on. Okay. And this is not for residences. All right. I got a lot of questions. Not. It's only for investment properties. All right. So just simply a 1031 exchange allows you to defer paying the gain on the sale of rental properties by reducing the basis of a new property. Very simple. So I'll give an example here. Okay, so I have an existing rental property. We sold it for $1 million. The purchase price we had of that years ago was $400,000. We had $200,000 of depreciation, right? So our basis is $200,000. Everyone understands that. Our gain is $800,000. So if we were to sell this now and take the money, we have to pay capital gains of $800,000. If we buy a new one and do it correctly, that's what we have on the right side. So now we're going to buy a property that's more expensive than the old one, which is important, equal or greater pricing. So we have $2 million that we bought it for. Now that deferred gain, the $800,000 from the bottom of the left column, reduces this basis. So now we have 1.2 million basis there for depreciation. So you see now, if we were to keep that for a few years and sell it, that 800,000 is waiting to be paid tax on. Does that make sense to everybody so far?
Mm-hmm. Yes.
Remember, if you take money at the closing, no 1031 is possible. I think was that clear and succinct enough?
It was.
Yes.
You mean you still got to pay the 800,000? I don't want to pay.
It's free.
It's free. I invested it.
All right, awesome. All right, so I know, Brenda, you wanted to discuss. Let me just get the share going up on here again so you can see this chart.
And for those that are watching, all the contact information for every guest is there to reach out for.
I know you wanted to show like how much houses have.
Yeah, that's a chart. That's a map rather, and it shows how much in the past 10 years or so, or 20. Excuse me. I shouldn't say 30 years. Houses have appreciated, and New Jersey, the housing prices have appreciated 243%, and that's over a great period of time. Obviously, that's with all the ups, downs, and sideways of the market, you know. But all it shows is that, you know, it is a fairly steady gain overall.
Exactly.
And that's really what you want, you know. Again, now another reason that the market most likely won't go down is supply is very limited, but demand is not. There are a lot of buyers out there. I represented a lot of them that were outbid constantly in that frenzy. And everybody's like, you know, we can't do anything until the baby boomers die, which unfortunately I'm one of them, but I ain't going anywhere. But it's you know, but the fact of the matter is there are more Gen Y generation people, 25 to 40 years old in the prime home buying market. There's more of them than there even were of boomers. So you've got a serious, you know, influx of buyers coming in there, and they're really looking to buy. And you know, the internet, I think sometimes has made people smarter. I think sometimes it's made people dumber. But, you know, the fact of the matter is you hook up with, you know, with a mortgage person, a CPA, insurance person, and of course a realtor that can really help you and really guide you. And there are ways to start out. Like we suggest, like a lot of the youngins, we get them to buy the condominiums and then they move on. You know, they take that equity and they move on, and they sell them or they rent them out. And now they've got an investment property. There's ways to do this. I mean, a lot of young folks say, "Oh, I've got college debt. I've got this." Come on, you know. I mean,
you have college debt. That's okay, because certain programs now we don't even have to calculate much of that payment for you. So
yeah, I mean, but they, you know, they're a little bit of a pity party. But it's like, you know, don't feel, you know, you could do this. You know, you could do this, and you should do this. You absolutely should do this.
So the myths are that you can't write off. We've already debunked that. You can totally write off. You're better off writing off interest than having a rent to pay that you can't do anything with. Okay, so we've done that. Then we got the pending market crash. I mean, historically, If you follow the rules of what have happened in history, there's no crash pending. The rates will rebound. It's always a good time to buy real estate because somewhere for
Sorry.
it's going to be a investment for you that you can leverage the asset to get more investment properties, to get a investment property to sell, to do the 1031 exchange. I mean, it all stems from the very beginning root of home ownership, of buying real estate. I mean, there's nothing, I can't think of anything bad about it.
Could I interject two things?
Yeah. Mm-hmm.
So number one, agents in New York or New Jersey, especially, please think of a national type of marketing strategy. I have clients all over the country, and there's certain political parties that run states and cities into the ground. I'm hypothetically, maybe there's certain ones that do that. And so there's so many people, families that are scared to death that need a place to go. So if I was an agent in Monmouth County, I'd be advertising in Portland, in San Francisco, in Los Angeles, in Minneapolis, right? So something to think about. If all the agents that I deal with, there's people out there, they just need some direction. I want to sell the safety of our communities here, which are very safe, Monmouth, Ocean counties. I tell all my clients, you got to move here. There's a great base of employees ready to go. We're very educated here. We have great universities here, right? And can I share my screen one more time?
Go for it.
Just to go with Brenda's last comment here. So home ownership, these are even more important than the tax benefits. So renters have no sense of permanence in a community as they can lose their lease annually. Owners create roots that they own, right? Even if taxes are a break even, you and not a landlord is getting, or you are getting the benefits of the annual appreciation. And as an owner, you can create the home you want, right? You are limited as to what kind of improvements or changes you can make when you are when you're a renter, right? So that's so important, the sense of permanence in a community for a growing family. And don't live with the anxiety of your lease not being renewed. Landlords they want more and more money. With a mortgage, we have a consistent payment for the next some odd decades if we want. So it's so much more permanent, and it's great for families, especially if you have children. You want to be buying instead of renting every day of the week.
I had a client call me the other day, and he goes, he just got his new lease to sign. He says, I would rather pay a 7% interest rate than sign this lease at this ridiculous amount. And I think that's where people are starting to look to. They're like, you know what? The rents are so ridiculous. I can't write off anything. I can't do any improvements to it. I have so many limitations. I'm going to go and I'm going to buy that house. And then when they do, they're so happy they did.
Well, don't forget to mention that even when the rates are 6%, that's totally offset by my increase in value, which is a non-taxable return on investment. So if I have an average of 4%, which is, let's say 4% across the country on average, real estate appreciation, so I'm only really paying 2%.
Exactly. Yeah, people only look at that number. They don't look at the whole picture.
And that's just today, Chris. We don't know what next year could be better. It's just today. So I mean, that's what people have to realize, that today is not forever. Things change and things often get better.
Yeah.
Definitely agree.
Awesome. Anybody else have anything they want to say?
I want to remind people that are out there, make sure you're honest and upfront in the beginning, because a lot of people try to do an investment property and for insurance purposes, they say, oh, it's going to be a primary residence. And I'm like, okay, so we process it at HO3. And then we have an inspector go out there a couple of weeks after closing, and all of a sudden there's, construction, there's a dumpster out there. They're like, oh yeah, I'm going to do some remodeling. I'm like, what? You just said you were going to live there. Yeah, I'm going to live there in a couple months. Well, that's a different policy. Yeah. We are not a HO3. It's not a primary residence yet. If you're doing renovations, you're doing a 203K loan, you probably need a builder's risk policy. You need a vacant home policy if you're not going to be there for extended periods of time. These are things that you got to be upfront. And I have it, and it happens. And they're like, you're canceling me. I'm like, I'm not doing anything. The company that we processed, because you said it was a primary residence, that's what's going on. They're always covering everyone out. Well, the inspector, keep everything up front. If you want to do renovations, that's
Listen,
fine.
you could do a renovation
You
loan.
can.
You could do
Right.
a home style renovation on an investment property.
Correct.
So
And
if
just-
it's not much different in the rate. You're being upfront and honest, and you can close. You know,
Right.
you close on your loan, you get the insurance the way you're supposed to, and everyone's happy. So don't just think that you have to do a certain way, because there's programs for everything.
There's another benefit. Remember, if you're homeowners, like I have an umbrella of personal liability on my homeowners. $2 million is very inexpensive. As a renter, you can't do that. One thing about LLCs I'd like to say about LLCs and investment properties, there's a lot of misunderstandings. LLCs, you can't just go out and run people over once you're an LLC and you have no liability. So the most important thing with investment properties is that we have them properly insured, because if you're an LLC owner, but you still have personal liability because you're the landlord person. So you want to make sure you have the right coverage. And I have a lot of people that don't even think about insurance too much. They're an LLC, totally wrong, because you still have personal liability. So to talk to Sean about that, I have several rental properties. And many of them are not an LLC at all. They're just in my name, because in my situation, there's no tax benefit, right? So always talk to someone like me and Sean. All four of us here, if you're thinking of buying an investment property, have a consult with all four of us, just like this on a call. It's worth the money and worth the time. The amount of money you're going to save and the peace of mind you're going to have is astronomical.
Well,
And if you have anything else you think you want to learn about or know about, you can just message us, and we can have like a series that we can just direct everything and clear all the myths and the misconceptions in this industry. Because honestly, I have been doing this a long time. And when I tell you that I run into the people that bought a house and have lived in it and raised their family, and they remember, and they're like, thank you so much for helping me through this. It's the best decision I ever made. People buy a car. They don't think of it as anything. They just go out and buy their car. And we like it. We don't like it. Like, this is your biggest investment. And it's got so much positive to it that we need to really just kind of get all this little negative myths out of the way.
That's another thing. When people say, oh, but 7% interest rates, I say, what do you pay for your car? What percent? What do you pay on your credit cards? And you're worried about a house? Which you're going to live in?
It's about control, right? So I get the question all the time, more than almost anybody. And I just say, well, who do you want to have control of where your family lives?
But a car doesn't get
simple question. Do you want to have control over where you live, or do you want a landlord to control where you live?
Yeah.
And so that's
how you live.
So even if it costs me more money, even if it costs me personally, being a father of 3, a grandfather of 2, I would go for the control over where my family lives. Even if it's, as I say, I don't care about the tax break. If people are thinking more about breaking even from a tax perspective, I understand the thought, but there's a broader issue that even if I'm paying more net money out of my pocket, the benefits of being able to control when and where my family live and where they move, that's priceless.
Exactly.
I have to agree there, Chris. I really do. I mean, it really makes a big difference in people's lives.
So what I do all day, tell me about it. I know.
Yeah. Well, I'll tell you, you mentioned a good point about how vacant house insurance. We do a lot. Some of the investors I work with are like, we buy stuff at auction. Well, we used to, because the auctions have been very much curtailed lately. But it was the first thing we did. The minute I got a bid accepted at auction, we'd be calling our insurance person, soon to be you, Sean, and like, we got to get vacant property insurance. We got to get it insured. We got to get this. We got to get that. And at first you think, oh, it's vacant. Well,
all right, guys. Well, I have to tell you, you are all amazing in your field, and I respect all of you so much, and I look forward to working with all of you again. And again, if anybody has anything that they want to learn about or know about, just let us know, because we definitely want to get rid of all the myths and debunk all the craziness that's going out there, all the fear. No fear. You should not be fearful. This is a beautiful thing, homeownership. No fear. It's just, we go in the car, somebody has a couple drinks, get in the car. They're not afraid of that. I'd be more afraid of that than buying a house. So thank you guys so very much. It's been a pleasure, and have a wonderful, wonderful night.
Thank you, everyone.
Thank you, everybody.
Take care. And thanks again. Thank you, Sean, for inviting.
Have an awesome day.
You too. You take care. Bye, Chris.